Many of you have asked me to analyze CoreWeave stock. The stock is down 14% over the last year. If you compare it to Nebius, Nebius is up 440%, and other neoclouds are up a lot over the last year, except CoreWeave, which was a legacy player. It was really popular. It's still very popular. Nvidia is invested in the company. Jensen Huang likes CoreWeave, but the stock is going down. I believe the setup over here is looking very, very interesting as a speculative investment. So I'm going to talk about CoreWeave today, and I really hope you enjoy it as always. Now, the CEO of CoreWeave said that he reached the hyperscaler capacity because he's been increasing capacity a lot. He has some pretty decent players, you could say premier tier 1 players like Jane Street as a customer, Meta, very recently Anthropic, Perplexity, World Labs. They signed a deal with all those players, and they've been delivering and they've been growing very, very rapidly. It's looking really good, but they did miss on their last earnings call. They missed on earnings per share. They got $1.12 of a loss versus 90 cents expected, and revenue, they slightly beat on revenue. They also missed on guidance, was about 2.5 billion. The street was expecting almost 2.7 billion. So Wall Street didn't like it, and everyone's been selling the stock. And everyone has been becoming more and more bearish on the company and comparing it to Nebius, kind of like how people were comparing AMD to Nvidia like 10 or 11 months ago. And people love, again, choosing one player. Like, they believe that if one player is winning, the other one can't really win, and they can't coexist, even though the demand in compute is absolutely crazy. And I think Nebius could exist, CoreWeave could exist, a lot of those companies could exist. Was looking at the H200 rental prices with $6.40 per GPU hour. It's been crazy. Even the old H100s is sitting at $2.60. So this is something that I initially underplayed when I analyzed Nebius. I saw that the demand wasn't as strong, and maybe after a few years when they buy those GPUs, they just can't keep renting them for such levels. But the demand has far been outpacing supply, and it will likely be the case for the next few years, which is a very bullish environment for Nebius and CoreWeave. Now, CoreWeave has been growing nicely. Revenues is up 112% over the last quarter. It's been steadily going up every single quarter, which is amazing from the company. Adjusted EBITDA is 1.1 billion, a massive jump from the prior quarter, and it's been improving on the right trend. Now, looking at the backlog is very, very impressive. They put up $98 billion in backlog, which was up from $66 billion over the last quarter. So this is more than a $30 billion or almost a 50% increase in the backlog in one single quarter. This is quarter on quarter. So the growth is absolutely massive for CoreWeave, and the future growth is looking pretty amazing. Now, there's a major risk with this one, and it's mainly the debt. So if you look at the debt, they have about $25 billion in total debt, short-term debt, long-term debt together. It's about $25 billion against a $2 billion cash position. That's not enough. And they clearly have a lot of debt, almost, again, $22 billion of net debt for a $57 billion market cap. So that's definitely a lot of debt for the company. And the debt has become, again, so large that if you look at the latest income statement, they spent $536 million in interest expense alone. The company before tax lost $656 million. So if they did not have this debt, they would have almost became profitable on the business. Pretty much they only lost like $120 million if you adjust for interest expense. So the company is getting better, but they have a lot of debt. And the problem is that this debt is a very high interest rate. So the interest rate that they have is 15%, 11%, 9%, 9%, 7%, 10%, 10%, 2%, 7%, 6%, 10%, 12%. So this is very, very high interest rate debt, and it's clearly waiting on the company. Now, the good thing is that CoreWeave's profile has been improving, the credit rating has been improving, and the company is becoming more and more, you could say, profitable on an EBITDA basis. The rating agencies are liking it, and the company is striking better deals whenever they're doing financings. As an example, the recent financing round for CoreWeave, they crossed $3.1 billion in loan facility, and that was mainly on SOFR plus 4.5%, which is about 7 to 8% interest rate. Now, Now, 7 to 8%, it's still high, you could say, but it's not as high as they had before, around 15 and 11%. So it's getting better and better over time for the company. And if they can refinance some of this debt from 15 to, you could say, something like 7 or 8%, they could save a lot on interest expense alone. So this is still a problem with CoreWeave that Nebius didn't have. Nebius was flushed with cash and they could still sell a lot of businesses to raise cash. CoreWeave was not and is not in this position. They're going to have to either dilute the stock, which they're trying not to. So they're trying to take on the debt to do it. That's a lot of debt, high interest rate. But as the company is growing, the debt profile and the cost of capital will improve, which should help the company grow more efficiently over the long term. But the debt is definitely a major, major problem. Now, the good thing is with CoreWeave, and this is my personal thesis, is that NVIDIA will not really let them, you could say, fail. It's not going to let them get in trouble with NVIDIA owning 11% of the company. NVIDIA wants CoreWeave and Nebius and all of those neoclouds to succeed because they are one of the ones that are buying the NVIDIA GPUs. And they want them to keep buying those GPUs. So they're going to keep investing in the company. If the company needs some liquidity, I believe NVIDIA will likely help them out. They're securing a customer. It's not AMD, it's NVIDIA. They're stuck with NVIDIA forever. And NVIDIA wants them to see them succeed, because if they succeed, they're going to be buying more and more of those GPUs every 6 or 7 or 8 years, or for however long they're depreciating them, or how the growth profile looks like. But I mean, they're going to have to invest in the company. So I see this as a setup where it's like a leveraged bet on compute. It's very, very risky, but you have NVIDIA's backing with 11% of the company, and you have NVIDIA's interest for CoreWeave and Nebius and all of them to succeed. And I think if CoreWeave ever gets in trouble, I think NVIDIA will likely be there to step in and potentially help the company. So you kind of have a put option, you could say, on the stock where you have NVIDIA's backing, and I think they can potentially step in. But again, that's just my speculation. I'm not sure that will happen, but I think this is the most likely outcome. Now, in terms of the valuation, they're expecting $30 billion in annual revenue by the end of 2027. The current market cap is 57 billion. So on a market cap to revenue basis, they're trading at only 1.5 times 2027 annualized run rate of revenues. 1.5 times is dirt cheap for the company, especially for a company that's growing 100% in revenues, and especially for a company with a backlog that's expected to mostly be realized after 2027. So you're paying 1.5 times 2027 annualized revenues, but they have about 65% of the backlog that's not expected to be realized until 25 to 48 months from now for 39%, and about 25% will be realized 48 months plus from now. So after you pay 1.5 times 2027, the company still has massive runways on the backlogs that could potentially double or triple revenues again from this backlog alone, not including potential growth from the backlog. So the stock is definitely not expensive at all. I think it's undervalued, and it's setting up as a great speculative investment. Like if you're bullish on the demand of AI and demand around compute, I think CoreWeave is a much better alternative here versus Nebius. They have much better customers. They charge more per hour of GPUs than Nebius. So they are setting up really, really well, but they do have the debt problem. But I believe it's going to improve over time as the company becomes more profitable on an EBITDA basis. They will be able to secure better and better terms. And as they do that, they can refinance some of the debt and pay some of it off, reduce interest expense. The company is almost profitable. I mean, I adjusted for the numbers. They lost like 120 million. So it's definitely improving if you, again, adjust for the interest expense. So I think it's a good setup. And you have NVIDIA as an 11% owner in the company, and NVIDIA has every interest for CoreWeave to succeed because they're the one buying the NVIDIA GPUs. When CoreWeave succeeds, NVIDIA will succeed, and they're locking them up as a permanent customer, you could say. This is why NVIDIA is investing in Nebius and all of them, not because they like the companies, but because they know that if they succeed, they're gonna be like repeat customers for the next 20 or 50 years for NVIDIA's GPUs, and they're not going to be buying any other GPU than NVIDIA's. So I think the setup is really good, but I still believe it's a speculative investment. So if I had to buy it, it would not be more than 1 or 2% of the portfolio and see what happens. It's just really speculative. It's unprofitable, and I have a lot of that. But that's my opinion on CoreWeave. I hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.